Hello, welcome to module 10, lecture 2, which is going to address one of the celebrated method of forecasting income statement, namely percentage of sales method. When you are going to talk about the users community in general, whether internal or external, they are inclined to appraise the potential for generating profit at the end of the body corporates, and it is of immense significance when there is the requirement of executing financial decisions backed by varied objectives and varied interests. So, all the users are inclined to adopt the method of forecasting the profitability of the business organization by using the best possible method which is made available. And in line with that, percentage of sales method is one of the most extensively adopted method of projecting the income statement through which they can make a journey into the future and dig out what is the potential of the business organization in terms of generating profit down the line in the future. Now, when you are going to talk about percentage sale method, essentially we are intending to express all the items of income statement in relation to sales, and here we are assuming that all the items which are finding a place within the ambit of income statement are having a direct and proportionate relationship with that of sales, owing to the simple logic that if sales are there to increase all sorts of items which are having direct relationship with the sales, they will also move in the same direction and in the same magnitude. So, it is imperative on the part of the users community before executing the projection of income statement using percentage of sales method that they are there to establish the relationship which is causal in nature so far as different items of income statement and sales are concerned. Here a brief of percentage of sale method. It is assuming that the majority of expenses and balance sheet items fluctuate in direct proportion to sales. The percentage of sales method is a simple approach to income statement forecasting. This approach is frequently used in budgeting and financial planning, particularly to short to medium term projections. Just before I said that the users are expected to establish a causal relationship between different items which are falling under the purview of income statement to that of sales, and any change or movement in sales is going to lead to subsequent changes in all the items which have a bearing on sales, and in general they move in direct proportion, which is one of the fundamental assumption of percentage of sales method. Now, looking at the percentage of sales method, there are certain designated steps which are expected to be adopted while predicting income statement using percentage of sales method. Here the first step is to determine the base year financial items. Obviously, when you are going to quantify the futuristic financial variables which are falling under the purview of income statement, we are there to start somewhere or the other from the past. And here, so far as percentage sale method is concerned, we are there to use the past information as the base year information on the basis of which we are going to predict different items which are finding a place in the profit and loss account. Now, to start with, the base year is normally taken as that year which is free from major changes or fluctuations. That is one of the subjective assumptions while selecting the base year for the purpose of percentage of sales method. Now, moving to the second step, it is the calculation of each line items as a percentage of sales. Say for example, the base year information pertaining to sales is 2 lakh and the manufacturing expenses is 1 lakh. So, when you are going to express manufacturing expenses in terms of sales, looking at the base figure, we are going to say that manufacturing expenses is 50% of sales. Now down the line, if sales are going to increase from 2 lakh to 3 lakh, we are there to quantify the projected manufacturing expenses by using the same percentage over the new sales activity. Now in this case, it is 50% of 3 lakh, that is 1,50,000. So in that manner, we are there to quantify all the items which are there to be shown in the income statement so far as their projection is concerned by expressing each and every financial variable in terms of sales. After calculating the percentage in terms of sales, we are there to forecast sales for the specified period for which we are there to forecast the income statement. Because the starting point of percentage of sales method is to forecast the sales. Unless and otherwise we are there to have the forecasted figure pertaining to sales, we cannot start with the projection of income statement using percentage of sales method. So the third step is the estimation of sales which are going to be there down the line in that specified period for which we are intending to project the income statement. After forecasting the sales, the last step is to apply the percentage which have been deduced by using the base year information in relation to different items of income statement. We are there to calculate all those items using the same percentage which they are going to have with sales using the forecasted sales figure. Now moving further, when you are going to talk about percentage of sales method, they are not also free from impediments. There are certain bottlenecks which are always come on the way when you are going to project the income statement for the purpose of financial decision making in a robust and rational manner. There are certain limitations have been jotted down over here. Now the first one is it assumes all costs vary directly with sales. This is a very subjective and orthodox assumption owing to the simple fact that the costs are not always going to vary in direct proportion to that of the sales, which is one of the fundamental impediment to percentage of sales method. Moving further, it overlooks operational efficiency changes. Obviously, we all know that if a particular company is going to magnify its efficiency in terms of executing operational activities, the incurrence of cost is going to decline. But that has not been taken into consideration in case of percentage of sales method owing to the simple fact that the percentage which has already been calculated using the base year information is going to be used to forecast all the items in the same manner, keeping aside the magnification in operational efficiency so far as a body corporate is concerned. Moving further, it is not suitable for non-operating items. Obviously, when we are talking about non-operating items, they are not at all related to sales, but this method is based on the fundamental premise that all the items which are shown or finding a place in the income statement are in direct proportion. In other words, they are there to move in tandem with the sales, but non-operating items are not going to fluctuate or change in relation to changes in sales. Then the next is it ignores seasonal or cyclical variations. Obviously, we all know the business environment is highly vulnerable and it always get exposed to different macroeconomic conditions, socialistic changes, political issues, which are more or less ending up in a state which is making the business ecosystem highly vulnerable. But the percentage of sales method is not accommodating all sorts of fluctuations which are emanating from the market pervasive movements. Next one is inflexible for strategic changes. Obviously, when you are going to talk about strategic planning, we are there to take into consideration all other items which are not directly changing in relation to changes in sales, but the percentage of sales method is more or less getting centered towards that particular relationship of sales vis-a-vis other items which are shown in the income statement, and thereby many items which are not related to sales gets ignored, and that is why it is making the strategic planning inflexible, or in other words we may say it is very difficult to execute a pragmatic strategy when you are going to counter or handle different situations emanating from the peers in the so-called industry. Then the last limitation is it is not applicable to high growth or declining businesses. Obviously, this is one of the fundamental deficiency of percentage of sales method. When you are going to make use of percentage of sales method for income statement projection, whether to see that the business or the industry within which the business is falling under, they are going to behave in a very stable manner. If you are talking about an industry, or if you are talking about a company which is more or less experiencing a very high magnitude of change, either upward or downward, obviously the percentage of sales method is not going to be the adequate one to predict the income statement. Moving further, there is another method which is also extensively used by the users community when they are reading the future profit potential of the body corporates, and that is trend analysis. In trend analysis, we are there to make a simple and popular orientation with regard to forecasting trends by relying on the past facts and figures. It is examining the past financial data from multiple time periods to find recurring patterns or trends, and then extrapolating future numbers from these patterns. Obviously, here one of the fundamental assumption is that what was the situation or the occurrence in the past is going to be replicated in the short run future span of time, and if we are able to predict the trend or in a pattern which are getting experienced in different financial items which are finding a place within the income statement, we are in a position to predict the income statement by using those patterns or trends which are getting executed in the past so far as different financial variables are concerned. Then there are also certain formidable steps which are associated with trend analysis. The first step is collect historical data. As we all know, when you are going to talk about patterns or trends, a single financial variable or a single data is not going to talk about the pattern or trend. Rather, we are there to have the accumulation of at least more than 1 year of data, at least 2 years we may say, to talk about any pattern or trend. But if the number of past information available is more than 2 years, say 3 years, 4 years, then those time series information for a period of time instead of a particular point of time is going to more talk about the trends or pattern in a better way, so that under trend analysis it is always expected that we are there to gather as much information as possible with regard to the past or the historical perspective of a body corporate. The second step is compute the growth rate or trend by using different methods. One of the simplest way is to calculate the percentage change in terms of growth rate by comparing each year's figure. Say for example, we are having the information of 3 years, say 21, 22, 23. Now, when you are going to talk about the pattern or trend, we are there to calculate here the changes on a year over year basis, like what is the figure in 22, what is the figure in 21, then we are there to subtract the 21 figure from 22 and divided by the 21 figure, then multiplied by 100 in order to get the percentage change. Similarly, if there are 3 years data, we are going to have 2 years growth. If there are 4 years data, we are going to have 3 years growth. Then we are there to average it out, while we are talking about average annual growth rate, which is mostly used in trend analysis whenever we are going to project the income statement by using patterns or trends. Now, in step 3, we are there to predict the future values by using the average annual growth rate, which has been calculated based on past facts or past information. We are there to make use of those average annual growth rate, and we are there to predict the new values of those financial variables which are falling under the purview of income statement. Then the next step is adjust for known changes. After predicting the same, there may be some additional information given or extracted from the body corporate so far as their future conditions or situations are concerned. So, if there is the prevalence of any additional information related to the future states of affairs, that is expected to be inculcated while coming out with the final forecasted figure. Then in step 5, modify projections based on known or expected events. As I said, first we are there to consider, then we are there to inculcate, then we are there to make all possible changes as per the information available or as per the information given. Then we are there to quantify or project each and every financial variable by considering the average annual growth rate, and at the same time by considering all those information which are made available to the person who is into the task of forecasting so far as income statement is concerned. Then the last step is preparation of the projected income statement or the forecasted income statement by accumulating all the financial variables which are falling under the purview of the trend analysis method. Here we are there to be very careful while we are talking about the trends, because there may be the instance or there may be experiences that the growth rate on year over basis are going to be highly fluctuating. Say for example, if we are having 21, 22, 23 information and we calculated the growth from 22 to 21 and we calculated that the growth rate is say 50%, but when you are calculating the growth rate that is from 23, 22, then it may so happen we are coming across a figure of 2%. So, if it is so, we have to be very careful with regard to the calculation of average annual growth rate, because there is a heavy difference between the previous year growth and the subsequent year growth rate. So, that has to be handled with care when you are going to calculate the average annual growth rate with regard to different financial variables or with regard to different financial items are concerned, and specifically when you are going to talk about trend analysis as a method of projecting the income statement. Then we discussed the first method, that is percentage of sales method, is also not free from the deficiencies or impediments. Similar is the case with trend analysis as a method of projecting income statement, owing to the simple reason that there are also certain challenges which are to be taken into consideration while adopting trend analysis as a method of income statement projection. To start with, it assumes past trends will continue. In the intro part of trend analysis, I have made a mention of the fact that when you were adopting trend analysis as a method of projecting income statement, we are taking it for granted that the past situation, the past conditions to which the business had already had experience, the business is going to experience this same condition or situation down the line in the short span of future when we are going to talk about trend analysis. But in actual practice, we all know that past never repeats in real world of business. If it is getting repeated, it is by default or it is by chance. So, owing to the simple logic of pragmatic orientation, the trend analysis has been criticized on this particular front quite severely by the users community, owing to the simple reason that the past conditions will not be carried forward to the future when you are going to talk about the projection of income statement. Then the next is it ignores qualitative factors. Obviously, when you are going to talk about trends, it only takes into consideration the numbers. It cannot accommodate all those qualitative variables that is also having a bearing when we are going to talk about the operational performance of a business. When you are going to talk about the operational efficiency, it is a qualitative parameter, but it cannot be taken into consideration while we are using trend analysis as a method of projection of income statement. Then the third one is, it is overly simplistic. Obviously, when you are going to make a journey into the unknown world of future and we are taking it for granted that what has already happened in the past is going to happen in the same manner, in the same magnitude and with the same vigor, then it is rather a foolish approach when you are going to talk about projection of income statement using trend analysis. It is simply backed by the orientation that we are there to make it simple and easy so far as its application is concerned. But trend analysis is more or less diluting from its core objective so far as the prediction is concerned. With the anticipation of making that particular method simple and easy to use, we are ignoring a lot of formidable issues which may make the projection complex and complicated. Then the next is, it is sensitive to outliers. Just in the intro part while I was discussing about the steps, we are there to calculate the growth rate on a year over year basis. Now, when we are calculating the growth rate, let us say 5 years information is available, so we are there to going to have 4 different growth rates out of 5 years figure, and it may so happen in a particular year you are coming across a growth rate which is extremely on the higher side or which may be extremely on the lower side compared to other 3 figures. That is otherwise termed as outlier, because we all know that when you are going to average it out, all these 4 growth rate figures, we are there to divide it by 4. If there is the prevalence of outlier, obviously that is going to significantly influence the average calculation of that particular growth rate related to the variables. So, it is to be noted that whenever we are coming across any sort of growth rate which is not close enough to other figures, we are there to adopt a very cautionary approach, and that is one of the fundamental impediment of trend analysis, because we have no choice but to calculate average annual growth rate in the same manner by considering the outliers. Then the last one is, it does not account for capacity saturation limits. We all know that every company and its production activities, sales activities, execution of different operating activities are more or less conditional upon the capacity which is having a bearing with the infrastructure of the particular company. But when you are going to talk about trend analysis, if the sales has grown by 50% and the average growth rate in sales is 50%, we are taking it for granted that in the coming year the sales are going to grow in the same manner, but it is not going to be the case in actual practice, owing to the simple reason that if the sales are there to magnify at the rate of 50%, obviously we are going to have a backup with regard to the infrastructure facility which facilitate the production of additional units of products, and then only we are there to talk about additional 50% growth in sales in the coming year. So, when you are going to talk about trend analysis, it simply calculates the growth rate in numbers. It does not pay any heed or attention to the infrastructural conditionalities, the capacity at which the business is operating. If a particular business is operating at 100% capacity and we are going to project that the sales are going to grow at a rate of 50%, it is practically not viable. To make it viable, the company has to go for additional acquisition of the infrastructure, and then and there only the company can predict or talk about a magnification in sales by 50% or so on and so forth. So, when we are talking about the practical orientation of the income statement and it is related to a future span of time, all these items which are falling under the purview of income statement are more or less conditional upon different other facets of business, say manpower, say infrastructure requirements, say market share, say market size, then the peers, then the industry. There are a lot of conditionalities which are there in the business which is going to have a bearing on the profit making capacity of the business down the line in the future. Hence, when you are going to talk about trend analysis, there are many impediments and some of them have been discussed over here. Now, moving further, put all these methods together, whether it is percentage of sales method, whether it is trend analysis method, obviously they are most extensively adopted methods of using at the end of the user's community so far as projection of profit and loss account or income statement is concerned, but at the same time there are other methods which are more pragmatic and practical, say for example statistical methods, scenario analysis, sensitivity analysis or hybrid methods, which are also made available in the literature of accounting and finance and which can be expedited in a scientific and rational way for the purpose of projecting the income statement in a better way compared to percentage of sales method or trend analysis method of projecting income statement. I hope this introductory orientation with regard to percentage of sales method and trend analysis has been communicated well so far as the working of percentage of sales method and trend analysis method is concerned. The audience would be able to adopt these methods for the purpose of projection of income statement. Thank you. Thanks a lot for your patient hearing.